Hi there, welcome to this Kaplan masterclass on relevant costs. My name's Andrew Mower and I'm a tutor at Kaplan Financial. So what I'm hoping to get out of the session here is, first of all, understanding what relevant costs are. What do we mean when we say relevant costing? We're then going to think about what we need to ignore, so what we exclude when we're doing relevant costing, and potentially things that could come up in bigger MPV questions that you need to rule out. And thirdly, we'll finish with an example. So hopefully putting all this stuff into context and helping you to imagine what relevant costs feel like in the real world. Let's start with the definition then. A relevant cost, firstly, has to be future, incremental, and a cash flow. So they're the first three things we need to consider. So when we say in the future, anything in the past can just be ignored. Incremental means on top of what was happening previously. So on top of normal, so not anything that was happening previously. By making this decision, how much extra is it going to cost us? That's what that incremental bit means. We also then need to think about cash flows. So only cash flows, nothing accounting based. We want cash, we want facts when we're doing this relevant costing. And then we've also got this idea of an opportunity cost. Now that's what we're missing out on. And we can include that when we're doing our relevant costing. So if, for example, we were set to sell a machine for £10,000. So it was already, it was all lined up. We had a buyer ready for our machine, all set to use it for £10,000. And then we decided, actually, you know what? We can use that machine to carry on making this product that we need. So by keeping the machine, effectively, that's cost us £10,000 because we're missing out on that. Yeah, it's the foregone alternative. It's what we're missing out on. And that's the idea of an opportunity cost. So by saying, actually, you know what, we're going to keep it. We're going to not do that anymore. We're going to keep it. We're going to keep on using it. We've missed out on that £10,000 of income, and therefore that becomes an opportunity cost. That's almost like the initial investment cost of that. So opportunity costs, we can include, they are relevant, and it's what we're missing out on by making this particular decision. So things we need to ignore, and what they love doing in these exams is to throw in a few of these into bigger questions. So you might be doing a big NPV, an investment appraisal, for example, and they'll just slip a couple of these into your question and you think, do I need to include that? Now, if you do spot something that isn't relevant that we're going to look at here, just make sure you make a little note and just say, please note this is not relevant because, and just explain why. And quite often you'll get credit for that. So that's a really nice one. So if we firstly look at this category of it having to be in the future, so things that aren't in the future, sunk costs. Now, sunk costs are anything that have happened in the past. Now, that's a really common one they like thrown in. So last year, we paid £50,000 for some market research to be done. That's in the past. The idea here is we can't influence that. That money's gone. We've spent that. It's history. Ignore it. We need to only consider things we can actually influence going forwards. So anything in the past, any sunk costs, get rid of them, ignore them, and we won't include them in our costing. Equally, committed costs. Now, these are sometimes a bit sneaky because they'll say, yeah, we've got a bill we need to pay next week relating to, for example, that market research. Now, that is in the future. We haven't paid it yet, but because we've already received the service, they've already done the market research for us, we're committed to pay that. We're legally obliged to pay it. We may have signed a contract, whatever. So anything that we can't get out of, anything we're committed to, we can also ignore because we can't influence that. We've got no say over whether or not we use that or not. Equally, they might give you some historic values. So they might say that originally we bought this machine for £5,000 6 years ago. Anything like that, again, not interested. We're only thinking about things in the future. Thank you very much. Now, in terms of things not being incremental, they love giving you a share of existing costs. If you do this project, we will allocate it 10% of our head office costs. Now, the key thing here is we'd have to pay those anyway. Those head office costs would be incurred regardless of whether or not we do this project, whether or not we make this decision. And therefore, it's not incremental. Remember, incremental is on top of what was happening previously. And equally allocated overheads. So similar concepts. They might say, oh yeah, we'll give you a share of the rent of the factory. We're going to allocate this project a bit of the share of the rent of this factory. Assuming that the factory is the same factory as we had before, again, not relevant. It's not an additional cost. What you've got to be a little bit careful with is if there is some incremental fixed costs. So a lot of people mistakenly think that we can just rule out all fixed costs. But if it says by doing this project, we're going to incur extra fixed costs of £50,000 a year in order to rent an extra bit of space for the project, that does become relevant. That is incremental. So it's not a case of all fixed costs we rule out. It is anything that's existing. That's the key thing. And equally, existing staff. So sometimes they'll say, by doing this project, we'll use staff who have got some spare capacity and they're on annual salaries. Great, right? That's not actually costing us anything extra. That's no incremental cost to us. And therefore, yeah, we don't need to include it. So just watch out. But again, if they said we're going to have to hire some more staff to do this project, fine, we will include them. They will be relevant. And when we're looking at this, we're only looking at cash flows. We don't want any accounting stuff. Something like depreciation, it's not a cash flow, is it? It's not an actual thing. It's an accountant's way of recognizing a loss of value over time. Yeah, if you own a car, cars depreciate. Fine, I get that. But you don't pay a depreciation expense, do you? It's not like you go to the bank every month and say, oh, my car's depreciated another 50 quid. Here you go. All depreciation is just that loss of value over time. There isn't actually a cash implication. The cash implication for a car is you buy it at one price, you sell it a few years later for a lot less. That is it, isn't it? There's no sort of annual depreciation fee or anything with those. So it's not a cash flow, not interested. Equally, any accounting stuff that you'll see in more accounting subjects, so revaluations, provisions, all those sorts of bits. Again, we're not interested in. We just want these cash flows, please. And remember, if there are any of these in a bigger question, just make a little note and explain why you've excluded it. So I haven't used the 10% head office costs because they're not incremental and therefore not relevant to this decision. And again, that sort of thing picks up credit. So hopefully that is clear as a concept. We only want to include, when we're doing this relevant costing, we only want to include things that are in the future, are incremental and their cash flows, and we can also include opportunity costs. Now, when we use this stuff, then what is the point? This is really useful for one-off decisions and short-term decision making. We can't do this stuff all year round for every single project, because eventually we do need to think about things like our overhead costs and our staff costs and so on. This is best just for one-off quick decisions. So what I thought would be useful was to just do an example. And so I just made up a quick example here that hopefully helps illustrate the point. So I'm going to the shops. Should I take the bus or should I drive? So purely from a cost perspective, I'm not considering convenience, hygiene, the people that you might have to share your journey with and so on. I'm not taking any of that stuff into account. I'm purely looking at the costs here. Now, if you decide to drive, you decide to take the car, the relevant cost I'd want to include would be petrol. So we need to factor in the cost of petrol and also potentially the cost of a parking ticket. So there would be the two incremental costs. By making this decision, they're the additional costs that I would have to incur in order to do this. Now, with cars, again, yeah, I'm aware you're going to have to pay an insurance cost each year, aren't you? You might have to pay tax. There is depreciation. But we're not going to consider those. That insurance, you pay regardless, don't you? Your insurance is often an annual premium. You pay that. It's effectively a sunk cost. It's gone. And equally, you don't have to pay any additional insurance for every journey you make. There's no additional cost. So that insurance, we can just rule that out. That's not relevant for this one-off decision as to whether I should to drive or take the bus. And equally, tax, same concept. And as we discussed, depreciation, not a cash flow. Therefore, we wouldn't want to include that in our decision. So all I'd be looking at is the incremental cost of the petrol and my parking ticket. Now, if I were to take the bus fare would be a fairly obvious inclusion. So that is a relevant cost. It's future, it's incremental, and it is cash. We then potentially want to include this opportunity cost of missed earning. Now, I just threw this in here just to hopefully illustrate this point. The bus, I'm assuming, will take longer than driving to get to the shops. So let's say the bus takes an extra hour compared to driving. By the time you've waited at the bus stop, the actual journey takes longer. Everyone has to, you have to wait a while for everyone to get on and off and so on. So let's say it takes an extra hour to take the bus. And if you are paid for your work, so imagine you work at home and you're paid for your hourly output, there would be an opportunity cost there of these missed earnings. So you've missed out on an hour's worth of work by taking the bus. So therefore, that would have a cost implication potentially. Now, for most people, that wouldn't be a consideration because the majority of people are probably either on an annual salary, so it wouldn't affect that, or this wouldn't be in their work time. This is at a weekend, in which case it's not relevant at all. But just wanted to throw that idea of an opportunity cost in here just to get us thinking about it. So yeah, if by it taking longer, it means we're going to miss out on some earnings, okay, we would need to consider that. If there's some sort of annual bus membership, so if you pay an annual membership to be part of the crew that can take the bus, we wouldn't need to include that. Again, that's an annual thing that isn't affected by the number of journeys. So yeah, we wouldn't need to include that. It's effectively a sunk cost. Now, with both of these decisions, what you might notice, I haven't included something like the cost of the shopping. We assume that no matter which decision we take here, the amount of shopping we buy and everything else will be the same. And I know in reality, if you drive, you might be able to fit more in the car or whatever it is. But in a lot of these situations, when you've got these decisions, should we do this? Should we do this? There are a lot of things that will be the same regardless. So like I say, the cost of the shopping we'll assume will be the same. So we don't need to include that because it would just cancel out, wouldn't it? If we said, right, we're going to spend £30 at the shops either way, there's no need to include that in this decision. We'll assume that that's a given. It's the same either way, and we'll just look at these additional costs. Okay, that's it for this little video on relevant costs. I hope that was useful, and best of luck with your studies in the future.